Hi, this is Oliver. I'm making this video today in order to provide some information for educational purposes. This isn't financial advice. This is about the direction that GME and AMC are headed in. And we are, as of today, at February 4th, 2021, and we're looking into what's possibly going to be happening February 5th, 2021 and onward. So we're going to be doing a review of some of the events that have unfolded lately. And some of the things we're looking at, first and foremost, is we're looking, GME is currently down. As of today, it was down $38.91 per share. And that's a percentage price change of 42.1058%. And AMC was down $1.88 per share, or a percentage price change of minus 20.9588%. And according to the trading volume reported by Fidelity daily, it looks like there's also been a significant reduction in terms of the amount of volume of purchases and sales of both AMC and of GME. Before, they were taking a much greater total share, proportionally speaking, to the rest of the marketplace. So what's caused this price to drop? This all began when the purchasing power of those shares was restricted by many brokerage firms, and that includes TD Ameritrade, Schwab, Robinhood, which was as published by MarketWatch on January 27th. So that really kind of limited, in many ways derailed much of the momentum from that stock that we were seeing at the end of January. And this really stymied the growth from those aforementioned purchase restrictions. And there's been a continued sell-off after a brief buyback recovery period, which was on Friday, January 29th, at the end of the trading week last week. And that actually buyback period occurred due to the loosening of those restrictions temporarily. So upon the news of that being published, there was a little bit of those were starting to shoot back up, and we were getting excited again. But over this most recent trading week, there's been some concern, and a lot of what's been expressed this past week has been over short selling tactics. So right now, the hedge funds, part of what started this whole short squeeze was the hedge funds had a large short sale position on both AMC and GME, some of the highest short selling positions of any company in the marketplace. And investors took advantage of this, and they started buying up those shares. And to work against this, the fact that they were losing on their short positions, those hedge funds started to buy back shares of AMC and GME, causing the price to spike, gravitating towards the moon. But this past week, the shares have been dropping. So people have cited potential resources like short selling ladders. And one key figure that we've heard in the media lately is Jim Kramer, who's currently an MSNBC host, and he was actually a former hedge fund manager. And actually in a video cited in 2006, which is going to be posted in the link below, he actually was describing some of the tactics that are used to manipulate market trends by hedge funds that are short selling. And one just particular tactic he mentioned was how they can make large purchase orders pre-market to look like the market is going to open and have a good day. And then shortly after the bell, they're going to do some large sell-offs of those purchased orders while holding a big short position in that stock, so that people start to see the momentum of the downward trend after the market opens. And to the unsuspecting buyer of those stocks, or unwitting buyers, perhaps they got in early on the opening after they saw the pre-market action. So that's one particular tactic that he pointed out as a particular strategy of manipulation. And actually, something that is being discussed a lot also is the short interest value that hedge funds are taking, which just means that as they're shorting these positions, they're paying an interest on the amount that they're shorting in those companies. So every day it's going to hurt them more and more to carry those short positions. And this gets published as required twice per month. There's a requirement that this information about short interest gets reported. However, this also in and of itself can be deceptive, as pointed out by an article I'm going to post here by Justice Clark Little, which says, as described by the SEC themselves, a way that you can deceit the level of short interest you have in a stock is, as described here, trader A may enter a buy right transaction consisting of selling deep in the money calls and buying shares of stock against the call sale. And by doing so, trader A appears to have purchased shares to meet the broker's dealer's closeout obligation for the fail to deliver that resulted from the reverse conversion. In practice, however, the circumstances suggest that trader A has no intention of delivering shares and is instead reestablishing or extending a failed position. So this is a really good article. It's really kind of confusing there to really digest all of that because it's really over the top. But if you read the article, he goes into more descriptive of how that actually works. So he'll provide more analysis of how that works, and I'll post that in the link below. And that next report is going to be on actually February 9th. So we're going to be getting that short interest selling information on February 9th, which is going to show an updated report of positions that the hedge funds are taking. Of course, this could be a real momentum builder. So I know for a fact they're going to be doing everything they can to underreport what their positions actually are on shorting GME and AMC. They're going to try to minimize that as much as possible through any loopholes that exist or any other means, whether it be that they're going to take a larger short position the following day after that report gets published. Because they know, or it's a battle of perception that as what investors are going to be looking at is to see what percentage of that stock is getting shorted. And if it's going to be a low percentage, people are going to take that as bad news. If it's still a relatively high percentage, then people are going to get excited and start buying the stock up again. So they're definitely aware of that perception contest that's occurring. And I believe if investors can continue to hold their shares, which are now diluted well below peak value of where we saw the apex of trading, which was close to $500 per share for GME, then this is going to continue putting a lot of pressure on those hedge funds, which are paying that short interest and are also facing significant losses on the day while that price value is operating well above what it was in the beginning of January. So currently the market capitalization of GME, for instance, is about 3 times what it was at the beginning of January. So they're definitely still taking losses, even if they're trying to buy back shares, which cause squeeze, and performing other tactics to somehow reduce their losses. And another thing we can take a look at, which I think is an unfortunate event that occurred, is the kind of premature intervention by the government on this issue. So they're already kind of, in the media, it's been widely reported that they're already kind of investigating, for instance, Reddit and social media and that influence over reported potential manipulation of stock prices. And that's going to be carried out from none other than newly appointed U.S. Treasury Secretary Janet Yellen, who is also the former chair of the Federal Reserve under the Obama administration, actually. So, and not to mention that she also took an $800,000 speaking fee from Citadel, which was also being reported recently, but she's allowed to still apparently be nonpartisan and be able to carry out this investigation. We also had a recent interview with SEC current acting chairman Allison Heron-Lee, who describes the main thesis of government concern regarding meme stocks as a result of market manipulation to see if perhaps strategies like pump and dump are being employed. And they're also arguing against how this might be affecting efficient markets. So what they're pretty much saying is that the market capitalization of stocks like GME and AMC are way overvalued right now. And it's because all these investors are collecting their energies and working together to buy up shares. And forming strategies such as that, which is extending it way above what the normal efficient market value would be for those types of companies. And this is also, the idea of efficient markets is generally considered a natural occurrence, which gets balanced out in the stock market over time. And this is argued by market scholars such as Nobel Prize winner Robert Shiller, who also has some great lectures from Yale that you can see on YouTube. And overregulating the market certainly would have its obvious drawbacks. And people who've actually spoken out in the media, we have like Kevin O'Leary and entrepreneur and NBA owner Mark Cuban recently on an interview with MSNBC, who suggested that despite GME and AMC priced mostly based on speculation, he also compared this to what's going on with SPACs and other stocks that are well above evaluation, and in a lot of cases, SPACs don't even actually report earnings per dollar per share every quarter like other companies do. So those are based increasingly on speculation. And we can even ask, all in all, perhaps the evaluation of AMC and GME in the long term might even be closer to fair than we actually are led to believe. So a lot of changes have actually happened in the most recent months. There's been some discussion of GME looking more at a digitized play from their standard operations of brick and mortar stores. And this is fully in effect when we see things like Matt Francis, who was actually starting with Robert Cohen to the board, appointed. And we saw Matt Francis in a newly created role of Chief Technology Officer, who's starting February 15th. And he was recently an engineering leader at Amazon Web Services and held other senior level positions. And then we had Kelly Durkin, who was previously Chewy's President of Customer Service, and Josh Kruger, Vice President of Fulfillment, who previously also held position at Amazon, Walmart, and QVC. So they're definitely, GME, for instance, is definitely taking on a lot of different moves to show that they can continue to trend into, hopefully they have some great ideas from the executives about how they can transition into a broader digitized content from their brick and mortar style stores. And we also have AMC recently being able to pay off massive debts from, as reported, Silver Lake's ability to convert a $600 million debt note from AMC into stock. And further, BlackRock, an investment firm with over $8.67 trillion of assets, doubled its stake in AMC, according to a recent filing with the U.S. Securities Exchange Commission. So both of those companies, AMC, GME being GameStop, actually perhaps do have some hope for the future, even after this is all said and done, when it comes to the significant pop in interest that they received. It looks like they are still positioning themselves toward the future, and these evaluations might not be so far off anyhow. So even after all this kind of media hype goes away, and a lot of those social media people, Reddit users, no longer carry as much of an interest, it's still possible that these companies are in it for the long term, which would be another reason why people would still want to maybe hold on to those shares potentially. So anyway, this is kind of a recap of where we stand. Again, this is February 4th, 2021. We had closed about an hour ago the after hours trading segment following the regular market hours. And we're heading tomorrow, February 5th, 2021. And we're going to go ahead and see what happens and then go from there.